Hello, everybody, and welcome to the Dash Trader Newsroom 2024 Year in Review and Market Outlook for 2025. My name is Michael DeGioia, Director of Educational Services here at Dash Trader, joined by Jill Molandrino, Global Markets Reporter at Nasdaq. Jill, how are you?
Good, doing well. Happy New Year, Mike.
It's already 2025, and we're jumping right into the mix.
Yes.
Yeah, that we are. So we got Fed Chairman Powell throwing a little salt on the markets here, but 2024 was a great year for the markets. My question to you is, to a certain degree, can it continue into 2025? I mean, I get the feeling that the market was a little sugar coated, maybe by the Biden administration, trying to get the Democrats trying to stay in office in a couple of different ways. But needless to say, Fed Chairman Powell's comments really put the markets in a bearish direction, this December. And my question to you is what's on everybody's mind. Is this year-end profit taking, or is this maybe the start of a much needed market correction?
Yeah, Mike, it's a great question. And I think a lot of it depends on your time frame and how you are positioning yourself for the market. So for example, a long-term investor such as myself, these more near-term questions aren't something that I'm necessarily as concerned about. I think 2024, and you and I have said this in a number of ways, even going through the pandemic, that this year was an anomaly because of XYZ. I think 2024, the performance that we saw was absolutely fantastic in the economy, as well as the performance that we saw in most pockets of the market, not all. And I think, if you think about the end of 2023 and the expectation going to 2024 that we were to get 6 to 7 rate cuts, that never materialized. And then you saw how the performance was for 2024. It was nearly historic.
Yeah.
Now the expectation is that you're going to have less rate cuts, and the market is reacting in a different way. So it seems very counterintuitive. You would think that the suggestion we're going to have less rate cuts suggests that the economy is stronger. I think the biggest concern, or what that's signaling, is how much can the Fed keep inflation under control and employment at a good rate without having to leverage rate cuts. And I think that's really what the difference is. You have to remember too, there was a lot of juice going into the end of the year following the election in a number of asset classes. One, because it suggested that the Trump policy perhaps could be more favorable towards businesses and for tax policy in the digital asset space. We know what it signaled. And there was a lot of euphoria priced into the market. So to see, I think the bigger question isn't necessarily if people are pulling money out of the market or if it's turning bearish, but where is the money going? So is what the bond market has been signaling, is that starting to trickle down into the equity market, or perhaps there's just other areas that the market is thinking about putting capital to work? You have to remember that expectations for IPOs in the secondary market are really high this year as well, right?
Yeah.
There's a lot of money on the sidelines that private equity and VC has to free up because it's been locked up, or they're looking for other areas of opportunity. So it might not just be the pockets of the market that have performed, but they're looking for other areas to allocate capital to. So I think that's really the what's going to be the big tell here, not necessarily is it a bear market or are we heading to a recession.
Yeah. Okay. I mean, very good points. And let's just jump into the next area, which is a little bit of a concern. In 2024, markets were way up, but demand for mortgages, obviously, in a rising interest rate environment, at the end of we've started to cut rates at the end, but we were down nearly 22% in mortgage demand. Now, in some key markets, we did start to see housing prices drop, like in Florida and some other hot markets with some individual problems. I know in South Florida, they have all these kind of like buildings that are sinking, and there's all kinds of infrastructure that they need to add to with high homeowners fees. But in other markets like the South and in the mountain states, we still see those markets fairly strong. The question is inflation seems to be steady. It's been at least been kind of held back for a little while, and interest rates seem to be stable for the moment. What do you see for housing going into 2025?
Well, it's interesting. We did get a series of rate cuts here, and that certainly has been reflected in savings accounts and so forth. I've already gotten a couple of cuts in some of my higher yielding savings accounts. Not a surprise, but they do tend to cut those quicker than they do lending rates, whether it's credit cards, mortgage rates, etc. I think there's a couple of things. To your point, inflation, it's not going to drop to 2019 levels, but it is somewhat steady. And at the end of the day, supply is still really constricted in the housing market. So therefore,
Yeah.
prices are going to remain somewhat stable, if not move higher. I think, unemployment remains low. Inflation is not really moving one way or the other. And the fact that we're getting less rate cuts than perhaps expected means that mortgage rates may only drop a little bit next year. So I think it's more so not necessarily a specific economic data point you can point towards. It's more so supply and demand market forces, anecdotally. And again, this has nothing to do with, empirical data, but just from I see, observing Redfin or Zillow or areas within the market where I live, prices to me don't seem to have come down in the selling space. Prices, in fact, are about 1 to 2% higher than last year or stable. So it's not like anything has come down. So
Hmm.
I think it's just really the supply side and the fact that cuts aren't necessarily being reflected in the mortgage market, and there's expected to be less for next year. And also, I think because understanding what the incoming administration's policies are going to look like and how that's going to impact your own personal taxes, and whether you're an investor looking for a home, a consumer, I think there's also home buyers looking for clarity around that as well.
No, no, very good points. And I mean, that brings up our next slide, which is what's going to go on once the inauguration actually takes place. I mean, we've seen a lot of maneuvering. We saw, some changes in the management over at Meta today. We also saw, obviously Trump has been already talking about reciprocal tariffs. And my question to you was, how will reciprocal tariffs affect inflation and the U.S. economy in general? I mean, this is something that we really haven't. This is not a policy that has been used in recent years. I mean, it was used in the prior Trump administration, but this is really bringing back something from the 1800s, the use of tariffs in a major way.
Yeah, it's really interesting with tariffs, and I had a couple segments on this today on my show, and really, until we get past the first 100 days, it's going to be really hard to um, really quantify what that is going to look like. One of my guests made a really interesting point that the fact, consumer companies, as an example, were raising prices, it was related to inflation. But inflation year over year, again, not like it was 5 years ago. I mean, it's crazy. It's been 5 years already since the pandemic started. But,
It's crazy.
year over year, it hasn't, it's relatively flat to lower, right? So
Yes.
consumer goods companies can't necessarily leverage inflation as a means to raising prices. So if there are tariffs and it compresses their margins, it has to get passed down somewhere, and that could impact the consumer. And I think it is one of the bigger reasons I have economists concerned, because of the chunk of the pie that consumers are responsible for as it relates to GDP, which is 69-70%. I think what's interesting with the deportations and the effect on the labor market, and this is um, not a more interesting story, but something I'm curious to follow, and as it relates to the visas that have been spoken about, um, and with having the skill sets emigrate into the country, and that's really what the debate is around, and that becomes a social and cultural conversation as well. Making the way they're looking at the H-1B visas, are we having the right people come over, people that are working, that have clean records and are bringing a specific skill set, whether it's in tech, whether it's in healthcare? That's the type of workforce that the administration is looking for, and coming here legally makes sense. So I think that's going to be a really big conversation this year, because it's not just about the economy, but there's also a lot of social and political implications in there as well. If you were, super hardline as it relates to immigration, or taking more of a central position, that the administration has been communicating about over social media and so forth. Who knows? But as far as other pitfalls, Mike, it's so the things that we were talking about at the end of 2021 and what could impact the market, right? Then we get through 2022. Then at the end of 2022, AI becomes part of the narrative of the market, and it has not looked back since. What would the market have looked like without that narrative, right? Then you have something that, the news cycle the past 24 to 48 hours, what's happening in the US here, whether it's terrorism or whatever the
Mhm.
outcomes of these attacks we've witnessed over the past couple of days, what that's going to be. The news cycle moves so fast. Most of the time it's on anyone's bingo card. So it's really hard to identify what a pitfall could be. Nobody was talking about COVID at the end of, well, let's call it, prior to the fourth quarter of 2019.
Yeah.
So I think at the end of the day, as it relates to the stock market specifically, how corporates are performing, that is a fundamental that we can identify. There is a benchmark to it. There's guidance. There's companies providing outlook towards that. Other than that, it's no one has any idea, honestly.
Yeah, you know what's funny though is the two things that you mentioned that I just want to go back to. So I read an article over the weekend about the Biden economics going into the election, that they were fighting inflation with the illegal immigration flood that we had. That it was kind of a way to indirectly bring down inflation. So if you have mass deportations, that kind of the Amazon delivery people, the Uber drivers that are using their cousin's social security number, because they're using apps, they were using it to as a loophole to work in the United States to circumvent U.S. labor laws, and that was how they kind of brought down inflation so drastically in 2024. The question is if you do have mass deportations, does the price of labor in the United States go up due to the mass deportations? Because now there's not this segment in the market. Now, obviously, the Trump administration said they want to increase N1H1 kind of professional visas. But if you take out that low echelon of the market that were
Right.
doing the deliveries, what happens to the price of everything? Because that pretty much was an indirect fix for the inflation problem. It's
Yeah,
an interesting problem to think about.
it is an interesting problem. I don't honestly, I don't know if it's related to the gig economy workers. I haven't read or heard about that. As it relates to other services, agricultural or landscaping, that the agricultural segment is the first thing that comes to mind, and something that's more readily spoken about. Look, you can have this argument where you want to onshore manufacturing and other parts of the economy. American workers cost more money, more wages due to benefits and other things that we are fortunate to have, right?
Mhm.
So it's going to increase prices. And that's one of the reasons why a lot of what happens in the manufacturing supply chain space moved overseas. So
Yep.
it's it's almost like the chicken before the egg. If everyone is making a better living and the wages are sustainable and can keep up with the cost of living, that's a good thing, right? But then it
Absolutely.
makes goods more expensive. But then does everyone else's wages come up because things are more expensive? So it's it's almost like a chicken before the egg argument, because one faction of the economy is going to be
One
impacted
affects
or
the
not.
other. One has an influence on
Right.
the other. So you're just gonna
Right.
have to see how it plays out.
So then, really what is the answer there? And then it also comes with a specific skill set, whether you're talking about highly skilled individuals, like we mentioned in the tech or healthcare spaces, or some of these skills in the agricultural segment. I don't have A lot of people don't have that are US workers. So it's not as easy to plug and play. It's desire of people that want to work in certain segments of the market. And like I said, I don't have the skill set in the healthcare space. I'm certainly not a surgeon, and I certainly don't understand how, the agricultural world works. So I think it's not just wages, it's skills that matter too.
One last question. I thought of this pitfall as you were just talking right now. The concentration of the indexes in the Magnificent Seven as a potential pitfall. I mean, I don't know the exact percentages, but I was trying to look it up right before we got on here. But I mean, it seems like the market is incredibly concentrated in those Magnificent Seven, those big technology companies. Is that a concern, do you think, going forward, or is it still significantly diversified As the Dow is a little bit less diversified than the S&P and the Nasdaq, but the big seven do make up a tremendous portion of all of those major
Yeah.
indices.
Well, it's interesting comparing the Dow to the Nasdaq 100. It's apples to oranges. There's just different types of companies in there. The methodologies are different, as you know, Mike.
Yep.
So one of the reasons why the Nasdaq 100 is significantly outpaced the other indexes is for that reason as well. So, of course, the flip side, with the concentration in there is going to be a risk. I do think, though, that the portfolios of the Mag 7 have expanded in a way where they're not necessarily 100% competitive with each other either. So, for
Yeah.
example, we saw had NVIDIA where it, went through, I don't know if it was ever considered a correction, but down 8 to 10% and so forth. It's not as if it impacted, as goes NVIDIA, as goes the market, because the other constituents were able to hold up because there was other areas where they were outperforming that NVIDIA either didn't have exposure to, or they were catching up with NVIDIA in some way. So it feels as if the Mag 7 itself perhaps might have leveled the playing field in a certain way. I don't think it's as if as Apple goes, as Tesla goes, as what's it called, as NVIDIA
They're all
goes.
almost conglomerates at this point.
Right.
Conglomerates in specific sectors, like they're almost not. They're positioned in different areas.
It just feels as if, again, I don't have the data to support it in the back of my mind, but when we would see moves in one of the Mag 7 names, it would really impact the index in other areas of the market. You have to remember the S&P 500 has exposure to these names as well. But when we've seen one or the other have a move to the up or downside, it doesn't feel or seem as if it took the index and the entire market along with it.
Yeah, we've seen Alphabet go down. They had
Mhm.
Alphabet specific issues, and the markets need to shrug it off because the other six were still doing very well. So I agree with you. There is a degree of diversification in those conglomerates, and they are big, massive conglomerates at this point.
Yeah.
Yeah, to a certain degree. Well, Jill, thank you very much. Excellent insights as always, and
Thank
have a
you.
wonderful time in Vegas.
All right. I will. Thanks so much, guys.
See you
Take
in
care.
2 weeks.
See ya.
We had a pretty significant sell-off. We have bounced from the lows on, this is the DIA that I'm looking at, but I'm going to just put in the QQQ. So we have bounced off the lows. We had a pretty significant break on the daily. We were up in the morning and we gave most of those gains back. So here is the kind of a small N pattern on the Nasdaq. It's going to expand this a little bit. We got 8 minutes to the market close. So we have this kind of crossover of the two major moving averages, that's the 10 and the 20 period moving average. And we had that big sell-off. The question is whether or not the sell-off continues. We have just kind of gotten back up to what is prior support. So this was the morning support. We had a big rally. We gave back most of those gains, and then we sold off. And then we subsequently rallied after that, and have kind of come back to what was support is now resistance. Now, when I put in the SPY, pretty much the same pattern, but it's slightly more negative. We're really going to see what happens tomorrow. This has been a pretty slow start to the year. Today was the first day of trading. We kind of washed out after the we washed out after the initial kind of little surge of trading. We had a little bit to the upside, but then we gave it all back. Let's take a look at Meta, because Meta was up on that news. Meta had a big run to the upside on some changes in management, and we also have Apple. I mean, really, Apple kind of dragged on the market big time. We had a kind of a bloodbath on Apple, giving back, a tremendous amount of, basically about 7 points on Apple, 6.5, 7 points. MSFT, Microsoft has been underperforming, but certainly not doing as poorly as Apple. GOOG, Alphabet. Alphabet was underperforming, but made it all back, and has kind of been putting in a kind of a sideways triangle formation. We have Alphabet. We have, okay, let's do NVDA, NVIDIA. NVIDIA, like Jill had mentioned, had that 10% correction, but has since been slowly moving back up, and slowly trudging its way back higher. So NVIDIA holding strong. I mean, you look at some old economy stocks like ExxonMobil, really sold off hard and are starting to bounce a little bit. But, this was kind of a bearish bounce. And, certainly we have X, which also has got some kind of a takeover going on at the moment. I think Japan Nippon Steel was supposed to take over U.S. Steel, and it's pending regulator approval. So we have what looks like a very big end pattern on that chart. AMD, Advanced Micro Devices, certainly not performing very well these days. Certainly not performing like NVIDIA. As you saw, NVIDIA is kind of up and away. NFLX, Netflix is looking like it's possibly getting set to roll over. Apple had this kind of very similar kind of rollover pattern, right? You can see how Apple, once it sunk below its moving averages, started to sell off. We see the same thing shaping up for Netflix. So let me just bring this back up for 1 second, switch over to my other screen, and wrap things up for us. From my perspective, for trading for many years, this is the time that you have to really be cautious. Markets are way up near all-time highs, and if there's going to be a sell-off, it's going to be here where there is a correction, not necessarily a bear market, but certainly a sell-off, going into the new administration, when things haven't really taken shape as of yet. So that's it for our market analysis. Stay up to date with all things DAS by signing up for our newsletter. We have our big year in review and year going forward newsletter coming out next week. And you can subscribe to our YouTube channel at DAS Trader TV and the DAS Newsroom Reminders, and follow us on social media at by LinkedIn, Twitter, Facebook at DAS Trader, and of course on Instagram. See you all soon. Trade well, everybody.